Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Wanted to do a quick video with another update on my M1 Finance portfolio. This is a portfolio I have that is made up of two separate investing strategies, one Dividend Aristocrats based, another growth based. So obviously growth has been killed in the last couple of months. It's been an interesting year to be a growth investor. Everything is dropping and it's kind of not a surprise, but it's easy to get lost in the momentum on the way up. So that the way down can sometimes be surprising. I did this analysis on my blog on April 4th, so it's a couple of weeks back. I'm using the same data because it takes me a while to calculate the returns on my portfolio here. It's a lot of manual work because this stuff can be very misleading. If you've ever seen M1 portfolio returns, you can't count on this. It's not an 87% return. It's money weighted, whatever that means, right? You can kind of see here, hey, I have 31,000 in initial cash flow. The market gain is about 10 grand. So maybe it's a 25, 30% return if you count dividends. It's not an 87% return. And then on top of that, you have to account for the fact that I'm always adding money. So when I add money on April 7th, the returns from that time are a lot different than the money I added on September 13th or whenever, right? So it takes a lot of back of the napkin analysis to actually figure out these returns. But all in all, Dividend Aristocrats have done pretty well. If you're not familiar with my portfolio, Dividend Aristocrats are basically stocks in the S&P 500 that have raised or paid dividends for 25 years plus, raised and paid dividends, not or. These are consistent dividend payers, dividend growers. Generally, this portfolio historically has outperformed the S&P 500 and it's done pretty well during this downturn. Even if you look at the last quarter, it's still basically up, right? I haven't lost money in what's been a complete disaster for the market. Pretty good. This is a safe haven-ish. These stocks will still drop if there's a recession, but it's certainly not going to react like a growth portfolio might. So pretty well on this side. There have been some changes. I think I sold MB&T Bank because they bought PBCT, which was a Dividend Aristocrats. I keep track of all these moves in my spreadsheet that I'll share in the link down below. But the real story here is growth. We'll take a look at my growth portfolio. It has been an ugly story in the last year, in the last quarter. This thing is down 10%, down 19% year over year. If you look at the NASDAQ, if you look at the smaller cap space or the mid cap even space of the NASDAQ, companies are down 50, 60%. And I am not immune from that. You can kind of see e-commerce and fintech have absolutely gotten destroyed. I have been buying a bit, but not so much because I knew this was coming. Well, if I knew this was coming, I would have sold, but I expected that this was coming simply because some of the returns that we got post-pandemic were ridiculous, and they have normalized at this point. If you look at some of my biggest losers, C is down 38% from when I bought it, down quite a bit in the last year. Shopify down from a high of 1,600, trading in the 400 range now. And again, this isn't a huge surprise. It's just very easy to get lost in the momentum of the stock market. If you look at a stock like Shopify, for example, we are looking at a company that, like I said, traded at $1,600 just a couple of months ago. But the question is, did that valuation ever make sense? Even after dropping 57% in the last year, even after dropping 65% year to date, this is a $54 billion stock right now, enterprise value. And a company that maybe has a free cash flow estimate of 2.3 billion by 2026. So even at today's prices, an investor is getting 4% free cash flow yield on a 2026 forward basis. That's still pretty darn expensive when you consider what's happening in the market out there. When you've got inflation at 7 to 8 to 9%, you can get I bonds yielding 7 to 8% to mirror that inflation. Yields are going up, interest rates are going up, and as a result, because of all that, some of these stocks that were priced to absolute perfection, and since we're talking about a 4% 2026 cash flow yield at today's prices, this was a 1% 2026 cash flow yield a couple of months ago, maybe half a year ago, that's craziness, right? That is a very, very aggressive price point for a stock like this. Again, the assumptions here were that this thing is going to keep growing, but what happened is when they released their earnings, when they released some of their forward guidance, the growth started to slow down. And you're seeing that here in the 80% moving to 57%. Expectations for 22 are now in the 30% range, and that continues into 2024, 2025, 2026. But obviously, these estimates are based on what the management has provided, and also what companies are estimating, analysts are estimating rather. If there is a bit of a recession, if there is of a slowdown in the economy, some of these companies may struggle to even reach these revenue estimates. And that's kind of what we're seeing in the growth space right now. A lot of these stocks are heavily correcting really, really quickly to get back to market norms. And I certainly was not immune from that in my portfolio. You can see that most of these are still positive, which is a good thing. But a lot of these, especially in the fintech side, especially on the e-commerce side, whether it's whether it's Shopify, whether it's PayPal, Square, even Facebook, are down from when I bought them. And a lot of these I bought quite a while ago. So even investors who bought a year or two ago are just back to break even, or maybe even losing money at this point. If you were a buyer less than a year ago, if you were a buyer at 1,400, 1,500, I get it. It's very easy to get swept up in that euphoria of growth, to think that none of this is ever going to stop, that it's going to keep going on forever. But it's hard for that to happen. And when a market turn happens, as it did, a lot of these growth stocks get punished. Right now, a lot of other companies have moved a bit, but they haven't moved to the extent that some of these growth names have moved. You can kind of see back on some of these bigger cap names. I'm still up quite a bit on Microsoft, on Google, on Apple, on Nvidia, even Trade Desk, Visa. Tesla's still quite a bit up from where I bought it. I mean, I bought this thing at $210. It's trading well above 1,000 now. I should have bought more, but what are you going to do? I think there is still pain ahead for some of these names, and potentially, if the economic downturn turns out to be a real thing, it pushes past the tech space and starts hitting those names that are more safe havens. Because if you go back to the Dividend Aristocrats portfolio, a lot of these stocks haven't moved that much. A lot of these stocks are up quite a bit. And if a recession happens, these stocks will still have room to fall, right? And that hasn't happened yet, but I think it has the potential to happen. So am I doing anything about it? Not really. This is more of a hands-off portfolio, the Dividend Aristocrats one, but I wouldn't be surprised if both of these sectors continue to take hits going forward. And again, that all depends on what is the Fed going to do with rates, what's going to happen to inflation. If inflation suddenly slows down and suddenly the economy is in a slowdown, a downturn, maybe the Fed will stop raising rates and then things will start to kick back into gear. But the market is always forward looking, and right now it's pricing in quite a bit of slowdown in some of these growth names. And while that may mean bad things in the short term, I think it starts opening up opportunities again. I think Shopify is back to a spot where it's interesting again. I think a lot of these names are back to a spot where they're interesting again. Growth has been hit really hard, and that is reflected in my returns, but I think it's getting interesting again. And I want to share that with you because I want to be really open about this portfolio and the returns it generates and what's in it. And I do that by sharing this spreadsheet with you. You can kind of see my portfolio returns, the moves that I've made, dividends I get, etc. And I track all of my moves. And I've been relatively hands-off with the growth portfolio for a while, but I think I want to be a bit more active with managing it. The way I will do that is I started to trim some of the holdings down. I had 60 stocks in there. That's way too many to keep track of. I did make some moves when I started to get a bit worried about some of the valuations. I sold some shares of Trupanion, of Cloudflare, to reallocate to underweight assets. Obviously, I should have done more on that front because since then, since 12.4, these stocks have dropped quite a bit and others have as well. But I wasn't really all that active in managing this portfolio. I may be more active in the future, so you may see more changes. You can kind of see, hey, I removed Netflix after their earnings. I removed Guidewire. I added Upstart. I removed ANSS. I removed some other companies simply because there's too many stocks in this portfolio. If you look at it, I still have 54 holdings even after those removals. I want to trim this down to maybe 40 core holdings or something like that. And that's even a lot to keep track of, right? Because I can't read earnings reports for all of these companies. I can't keep track of what's going on with these companies. So I may start trimming this down in a bigger way and try to make this portfolio a bit more concise so I can manage it better. How do the returns look? I mean, that's really the key part here. Well, since the beginning, since I started tracking this, the portfolio is still above the S&P 500, but barely above. You can kind of see the dip here. And since I started making videos on this, really, if you invested $100, if you invested $100, when I started tracking these returns and showing them to you in the portfolio, the S&P 500 actually is probably beating me. Let me just double check that. 100% plus the total, since the returns in the last month were so terrible. Yep, I'm down and I am up. So yeah, I am trailing the S&P 500, and that's all because my growth portfolio is down 17.5%. 17.5% since 11/24, so it's a pretty big dip. In the same time frame, the S&P 500 is only down 3.4%. Luckily, the aristocrats that I talked about are basically flat. Altogether, though, since it's almost a 50-50 split between the two portfolios, it was down 9% in the last month. Not good returns, and it's really one of the reasons why it probably makes sense for most people to just be in the S&P 500. It's why the majority of my money is in index funds like the S&P 500. This is just a small portion of my portfolio. And as always, guys, not a qualified financial advisor. Please do your own due diligence before investing in any of these. But I think it's just fun to share some of this stuff, follow my journey, etc. So what happened here? Well, growth was absolutely obliterated, like I said. It really pushed the story away from growth. And that's kind of where you live in the growth space, right? Growth often is very momentum driven, right? Things are looking amazing until they're not. And right now they're not. And that drop was relatively precipitous. If we just go back to a year, great. Oh shit, what? It keeps going down. So it's just going down and going down and going down. And I mean, even hell, in the last week, this thing's been probably down like 10%. So very quick moves on growth, on the way up, on the way down. It's very easy to be blindsided by this. And it's very easy to lose track of valuations. And I'm totally guilty of this within this portfolio. Yeah, I may have noticed that Netflare or Trupanion were looking a bit expensive in December, but I should have looked at all of my stocks. It's just difficult to do that when you're looking at 50, 60 plus names. And again, I wasn't going to sell all of them. This is a long-term investment thesis. Luckily, if you watch some of my other videos, hey, I probably mentioned, or at least in my blog post as well, I mentioned that growth looks a bit expensive. I'm probably not buying as much, and I was putting more money into the Dividend Aristocrats portfolio and M1 Finance. Well, now as I get some additional funds, I'm putting that more so into the growth names because they're starting to get interesting again, right? 4% 2026 cash flow yield isn't that amazing, but if you look at something like Google, which I recently increased my allocation of, you're talking about a 1.5 trillion market cap, which is a lot, but these guys are generating 80 billion in free cash flow estimated in 2022. It'll be interesting to see what their earnings look like, but you're talking about 4 to 5% free cash flow yield today on something like this, which is pretty darn good against, 4% free cash flow yield in 2026. By the time this hits 2026, the estimates are that this is hitting 10% cash flow yield. So what's a better investment? Google looks certainly very interesting right now. They did have an amazing growth year in 21. That means in 2022, the comps are a lot harder. Will earnings slow down? There's a lot of earnings coming up in the next week or two, whether it's Google, whether it's Facebook, soon Apple and Microsoft. They'll kind of paint the picture for the larger cap names that have held up quite well so far. But if the earnings there aren't very good, quite well except for Facebook, I'll say that. If the earnings there aren't very good, that could change the way the stock market swings from there. Today we're down a bit again. It's certainly a marketplace that is on the downturn, but this is when buying gets interesting, right? I'd rather buy when things are looking red than when things are up, 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 and it seems like they can't stop going up, because that's when you get those 2026 1% cash flow yield purchases. And those aren't good long-term purchases, right? You want to buy things that are going to generate increasing cash flow that is going to beat something like a bond. And 1% in 2026, that's not a very impressive purchase when I could probably get a bond that's going to do that in 2026, a 5-year bond at that point, and yields were near nothing. So that's the kind of trade-off you have to make. Now those trade-offs are becoming a lot more interesting because you can get some of these growth names at interesting cash flow yields. And that's really what I look at. I look at, is this company going to generate cash flow? If it's not today, when is that going to happen? Can I see the path there? Because if I can see the path there and I can buy it today and lock in a 5 to 10% cash flow yield a couple of years from now, and that's growing from there, that is an interesting thesis to me. And on some of these stocks, you can do 4 to 5 to 6% even today or a year or two from now, based on today's prices. And that's certainly an interesting valuation. If you look at some of this, you can look at levered free cash flow. Google hasn't been there for quite some time. It's back to 2017 prices on that front. And Google's done really well since then. So you're talking about some interesting valuations, and it seems to keep going down. So I'll probably keep adding if that happens. Again, you're only back to 2021 prices, but then also your free cash flow is quite a bit higher now than it was back then. So that's the interesting part of this story. It'll be interesting to see what their earnings look like a couple of days from now. But until then, this was just a quick update. Let me know what you guys think about this. As always, not a qualified financial advisor. Please do your own due diligence. Just want to do a quick update, share this updated portfolio with you. You can see my returns here. It'll be in the description down below. You can see the terrible growth returns. You can see the growth portfolio itself and kind of follow it along with the moves that I make. There might be more moves in the future. I'm removing certain stocks, adding other stocks. Like I said, I want to trim down the portfolio to have less names to keep track of, because it's very difficult to keep track of as many stocks as I have in there. So keep an eye out for that. Keep an eye out for future updates and future stock videos. As always, just doing this for fun. If you're an investor, again, not a qualified financial advisor, but the easiest thing for you to do, just put your money at an S&P 500 dollar cost average into that. That's what I do with the majority of my money. Anybody who tells you otherwise is probably trying to sell you something. That's the path you should take, because otherwise you're going to make some dumb moves and you're going to have a negative 18% return in a couple of months. And you're going to be like, what the F? Why did I do that when I could have had negative 3% in the S&P 500 and I probably could have done better? Well, you do that because in the long run, this strategy might play out to what you think it will, right? And a lot of strategies do take 5 to 10 to 15 years to actually play out. And if you don't have that time, you don't have the ability to commit to something for that long, and feel that what you're doing is correct, picking stocks might not be for you unless you want short-term returns. It's just, hey, put your money in S&P 500 stock fund and you'll be good to go across 20 to 30 years, because this is a 20 to 30 year investment timeline for me, right? I'm not buying these things because I'm going to get a 20% boost next month or a 20% decrease next month. I'm buying these companies because I think at certain price points they can return excellent rewards across a long period of time, and that's what this is about. So that's kind of proven out so far. In the short term, it certainly hasn't. Might certainly dip below the S&P 500 next time. In fact, I'm probably there now, given how the growth stocks have been punished since the 4.3 update, but sort of is what it is. Just wanted to do a quick update. Thanks for watching. Have a good rest of your day, guys.